Perfect. So welcome everybody to Bridges to Better Business. To our this is our October month program. My name is Angie. I am the program coordinator for the Business Center Guelph-Wellington, and today we are joined with two representatives from RLB, Blake DeLuca and Eric Tuffnail. Eric, I think your last name is really cool, but that's every time I hear it, I'm like, that's hilarious. It's amazing. So I am going to hand it over to Blake and Eric in a second, but just know that I will be monitoring the chats on our Facebook stream and in the live chat here. So if you have any questions, please throw them up there and I will get them out to you. So Blake, Eric, welcome for joining us.
Thanks, Angela, and thanks everyone for joining. Eric and I are here today to talk about tax and accounting and some of the considerations for small businesses and in the startup phase. As Angela said before, feel free to jump in if you do have questions. I don't think either of us are offended if you interrupt. Happy to have an open discussion. So I'll jump into a quick introduction of the two of us first. My name again is Blake DeLuca. I'm a tax manager at RLB. So my focus is on indirect tax, so GST, HST, and cross-border tax. And Eric, I'll let you introduce yourself and take it from there.
Great, yeah, thanks, Blake. Good afternoon, everyone. My name is Eric Tuffnail. I'm a CPA accounting manager at RLB. So I kind of deal with more small business, growing businesses, as well as sole proprietors going into an incorporated business at RLB, as well as incorporating personal taxes with corporate taxes for the overall tax plan for our clients. So, and kind of moving on, we've got a kind of a loose agenda that we're going to go by here. So we're going to firstly start off with going through like a business structure. Blake's going to touch on some HST information, and then we'll get into what kind of record keeping you should be doing on an annual basis, as well as some compensation for business owners, as well as hiring employees and how to pay your employees. We're going to go through some other considerations as well, and Blake and I will kind of tag team that near the end of the presentation. And so just to give you a little bit about RLB. So we're an accounting firm, and we service a lot of the Southwestern Ontario region, and we've been around for about 70 years. We are a legacy firm, which means that we're going to be here to stay. We're not going to be bought out by one of the big firms and whatnot. So that's always nice that we're going to be, in the community and whatnot. We do have 5 offices now. So Guelph, Fergus, Kitchener, Orangeville, and today is actually our grand opening at the Shelburne office. So it's a very exciting day for our firm and our growth. And yeah, that kind of gives a brief kind of outline as to what we do. Anything from financial planning, tax, business management, business succession, HR consulting, obviously the accounting side of things, and there's so much more too. So yeah, that kind of gives a little bit of a brief introduction to the firm, and I believe now it'll be passed on over to Blake.
Great, thanks, Eric. So the first thing I was going to talk about is structuring your business. It's a decision that pretty much every business will have to make at the startup, and it's something that can be continued to be reevaluated, whether your business is structured most efficiently from a tax perspective, whether it makes sense from a legal perspective, and all kinds of other considerations. So there's a few options in Canada. I'll go over some of the main options as to how you can structure your business. Firstly, I'll start with conducting business as a sole proprietor. As you may know, it's probably the easiest and least costly way to conduct business. Your compliance costs, so tax and accounting fees, legal fees, they're really minimal as a sole proprietor. Really, your main obligation is to deal with your personal income taxes and GST, HST. There's also less administrative work, so less information that needs to go with your personal tax return. No balance sheet, so we're not looking at the assets and liabilities of the sole proprietor. Really, you're just responsible for reporting your income and expenses on your personal tax return. Finally, one of the other pros of a sole proprietorship, especially in the startup phase, is the ability to use losses. So a new business may actually spend more than it makes in that startup phase. And those losses in the initial years can be used to offset other sources of income. So if you're sort of on a part-time startup and you have some other part-time source of income, a loss from your new business could offset the income from another source and reduce your overall tax bill. In terms of some of the drawbacks to sole proprietorship, the one main consideration I think is liability. So in the sole proprietor case, there's no real distinction between you personally and the business. You essentially are the business. So if there is a liability that arises from the business, if there's a lawsuit, something like that, your personal assets can also be brought into that liability. I would certainly recommend discussing that more with your lawyer, and I'll probably repeat that a few times because there are certainly legal considerations with a lot of this. Also, as a sole proprietor, there is less ability for tax planning. So one concept that a lot of accountants like to use is tax deferral. So paying tax later when you actually need to access the funds personally. In this case, because you, again, are the sole proprietor, you are the business, you will pay tax as you earn the money. There's really no ability to defer tax into the future for the most part. The other drawback as a sole proprietor is if you were to go to sell your business, if you get to that stage, there's really no relief offered for the sale of your business, whereas there is some tax incentives for the sale of a small business corporation, which we can talk a little bit about more later. And finally, there could be some additional financing challenges as a sole proprietor. The financing would be in your personal name, so it would mean having to give some consideration to your other personal assets and liabilities if you're looking to secure financing. One sort of step up from that, and if you're doing business with one more person or a number of different people as partners, is you could consider a partnership. So a partnership is really just a relationship between two or more persons with the view of profit. So you're taking on this business with the expectation or the goal to make a profit. There's no legal requirement to have anything documented. You don't necessarily need a partnership agreement, but I would certainly recommend having something documented with your partners. If this is a route that you want to go, one, it would document your split in terms of the income and expenses, whether that's 50-50 or some other agreed upon amount. And also in case other sort of unusual events come up, say one of the partners want to exit the business or is no longer able to conduct business, or you want to bring someone new into the business, having an agreement in place and working with a lawyer would help to structure how those events get handled. And it's always better to do that in advance. And finally, probably one of the most common business structures in Canada is a corporation. So a corporation is actually a legal entity, whereas the other two really are not. And the benefit of that as a legal entity is you're separating yourself from your business. You do have a decision as in incorporating as to whether you incorporate under federal legislation or provincial legislation. The benefit of a federal corporation, one, is if you do plan to conduct business across Canada, that name would be protected across Canada. Flexibility, you can have your address really anywhere within Canada. And a federal corporation is actually cheaper generally to set up. but I believe it does require an annual filing fee to maintain the corporation. Whereas the provincial corporation, it can be more costly to set up, but no annual fee that you need to pay to the government to maintain that corporation. So some of the benefits of incorporation, they're sort of the opposite of sole proprietor. So you're limiting your liability as a corporation. You're separating yourself personally from the corporation. So if something were to go wrong in the corporation, generally someone can't come back to you personally and seek you to cover that liability from your personal assets. There are some rules for director's liability. So basically, as a director of the corporation, you would still be responsible to cover unpaid taxes, so income tax or sales tax, if something is arising from the business. There's certainly more ability to tax plan as a corporation. You can sort of take money out of the business as you need, and it allows you to defer personal tax over time, and also utilize your marginal tax rates. So just to give you an example, the tax rate for a small business in Ontario with less than $500,000 in income, this is for a corporation, would be 12.2% currently. Whereas as a sole proprietor, we would have marginal tax rates, but the top personal tax rate is actually over 50%. It's 53%. So there can be some huge tax deferral if you don't need all of the money you're making, and it can essentially stay in that corporation and get reinvested in the business. Another big advantage to a corporation, if you do anticipate that you may be in a position to sell your business at some point, is the capital gains deduction. So as a small business corporation, and there are requirements that you would need to look at if this does come up, you can actually have a tax-free capital gain on your small business corporation shares if you were to sell them to somebody else. And it's currently capped out at about $890,000. So it's a pretty significant tax savings that you can realize from incorporating. A few other of the smaller benefits, employee benefits, would allow you to offer benefits to your employees in certain situations where it may receive special tax treatment in their hands, and the corporation can still claim a deduction against the business income from corporate tax. Scientific research and experimental development. The government does offer some credits for qualifying activities that are considered scientific research. So if you're in that field, they will essentially reimburse you for a portion of the cost that you incur, because they're just trying to encourage those activities. And it's generally higher as a corporation. It can be up to about 35% of the expense, whereas an individual would be limited to about 15% as a scientific research expense. And finally, it may be easier to access capital as a corporation. Your corporation might be able to borrow money at lower rates, but that would probably depend on the bank. Some of the costs or the drawbacks of incorporation, certainly the compliance cost and the administrative work. There is much more compliance cost as a corporation. One, you would likely need to work with a lawyer and an accountant to actually set up the corporation. And then there would be annual filings, annual tax filings, and annual legal filings that you would need to do as well. So you're increasing your costs a fair bit. And also more administrative work. There's more reporting that's required for corporate tax purposes, more legal reporting that needs to go to the government, and just generally more work as an incorporated business. So it's not a decision you want to take lightly. You have to sort of weigh these factors into account when you're looking at the positives. And finally, the limitation on the use of losses. So sort of the opposite as a sole proprietor. If you are in the startup phase and you're incurring losses in your corporation, the losses can only really be used to offset income in the corporation. So it can never really affect you personally, and you can't benefit from that if you have other sources of income personally. So again, just want to repeat, these are some mostly tax considerations to incorporation. Definitely discuss with a legal professional if you are considering this route to get their input as well. Any questions on the business structures before I jump into HST? No?
I don't see anything on any of the chat.
Okay. Great. So HST I felt like was important to talk about as it's not a well understood area, and it comes up fairly frequently, even for small businesses. It's something that if you handle really well, it can potentially work to your advantage. But when it's not handled well, it is an area of interest for the Canada Revenue Agency. So certainly something to keep your eye on. So HST, it's a value-added tax. It basically applies at every step in the supply chain. So if you purchase something, HST will generally apply. But as a business who, if you are registered for HST, you can recover the HST you pay in your business as an input tax credit. There are exceptions to this or exemptions that are listed in the Excise Tax Act. So if you've already determined or you know that your business is an exempt activity where HST doesn't apply, for example, medical, then you can disregard some of these comments. But if HST does apply to your business, which it does to most, then these are important things to consider. So in terms of registering for HST, you must register once you exceed $30,000 small supplier threshold. And that applies on a quarterly basis. So within 4 quarters, if you exceed $30,000, that's where you would be required to register and begin collecting HST. There are differences in terms of how often you will have to file. So any business with taxable supplies or revenues under 1.5 million can file annually. If you fall between 1.5 million and 6 million in revenues, you would need to file quarterly. And if you file, if you have more than 6 million in revenues or taxable supplies, you would need to file on a monthly basis. For annual filers, the due date is 3 months after the tax or after the year, unless you're a sole proprietor, in which case your due date will basically be the same as your personal tax return, so likely June 15th. For monthly and quarterly filers, the due date will be 1 month after your reporting period. And I'll also note there are other sales taxes in Canada. So GST and HST, some provinces have chosen to harmonize their provincial sales tax with the federal tax. So that's what HST stands for. There's also 4 provinces who have not done that. So British Columbia, Saskatchewan, Manitoba, and Quebec. They would all have their own provincial sales taxes as well. So just something to consider if you're selling into multiple provinces. So in terms of claiming input tax credits, so this is where you're claiming HST on an expense that you incur in your business. There's specific rules to allow you to do that. One, the property or service would need to be acquired by you as the business owner. So important that it would actually be issued to you in your name or the business name. If it becomes, the HST would need to become payable in a reporting period where you are registered for HST. So this is especially important in the startup phase, where you might incur expenses before you exceed that $30,000 threshold. If you have chosen to become registered in advance, you can actually claim credits even before you begin to receive revenues. And then the other requirement is that you can claim credit to the extent that the property was used in your commercial activity. So what that means is basically the expense needs to be incurred for you to use in your business. If there's some split between personal and your business, then we would need to look at an allocation between the two. Other requirements, obviously very important to have the appropriate documentation on hand. And Eric will talk a little bit more about record keeping later on. But for HST, it's especially important because I do see the CRA review this area quite frequently. And the claim would need to be made within 4 years of you incurring that expense. So I've inserted this chart into our slides. I thought this was helpful just to give you an idea of some of the documentation requirements that exist and that CRA would look for. So this is both on your revenue side if you're the one issuing invoices, and also on your expense side if you're collecting invoices or expenses for your records. Something to take into consideration what actually needs to be on those invoices in order to qualify. If we're talking smaller expenses under $100, you'll see we really just need the supplier's name, the date of the invoice, and the total amount payable. It's fairly simple. If we then are between $100 and $500, a little bit more information the CRA would look for. One, they would want to see the specific amount of GST or HST charged on the invoice, the tax rate, and also the business number of the supplier. So the person who is making the sale should be on the invoice. And then if we exceed $500 in terms of an invoice, a few other requirements, the name of the purchaser, so the person who's acquiring the good or service should also be somewhere on the invoice. Description of what is actually being sold. And finally, terms of the payment if payment is not being made on site, basically. In terms of allocation methods, so this deals with situations where maybe there is a split between personal and business use, or there's a split of an expense between an exempt activity or a taxable activity for HST. CRA really doesn't have a prescribed method to allocate these items. So for example, let's say your home office expenses. CRA doesn't have a prescribed method where you have to allocate your expenses on a certain way for HST. All they really look for is that the method you choose is fair and reasonable. So in that example of home office, fair and reasonable to me would probably be square footage. So square footage of your office in comparison to your home, but there can be other less obvious examples, I would say. Finally, a few other practical considerations to HST. One, I mentioned before, you can voluntarily register before you are required to register. And the benefit of that is as soon as you're in the HST system, you can claim input tax credits on your expenses. So you would just need to apply for an HST number even before you hit that $30,000 in taxable supplies. You can do this from day one. Filing frequency. So in the startup phase to a business, I know it sounds nice and easy to just have an annual filing once a year, but if you're actually incurring more expenses than you're making in revenue, you might anticipate a refund from HST where you're claiming back the HST on your expenditures. So it might work to your advantage to file more frequently. So filing monthly or quarterly, you can get those refunds back quicker in the startup phase. And finally, there is a quick method election available. Basically, what the quick method election allows you to do is remit only a portion of the HST you collect, and then you would not claim input tax credits on your expenditures. So it's kind of like a simplified method of dealing with HST where I believe it's either 8.8% or 4.4%, depending on the type of business. You would just take that and remit that to CRA instead of the 13% minus your expenses. That can work especially well in businesses with very little expenses. So consulting services for one. That concludes the HST section of our presentation. Any questions regarding HST? No?
I don't have anything on any of the chats again, so.
Okay, great. So I'll pass it over to Eric, and Eric's going to talk about keeping records.
Great. Yeah, thanks for all that, Blake. Yeah, so we're going to get into a little bit of kind of what records you should be keeping, what kind of qualifies as records, as well as why you should keep them and how long you should keep them for. So for starters, what qualifies as records? So we'd recommend keeping anything from financial statements, receipts, sales invoices, your personal and or corporate income tax returns, as well as bank statements and credit card receipts. Pretty much a simple rule of thumb, any and all receipts that support the transactions that your business or sole proprietorship is incurring, you should keep those. You're able to keep them in a PDF or electronic format. I've seen clients starting to do that so that they don't have, banker's boxes of documents. So they just keep it all or take photos of it or scan it and keep it all on a storage hard drive. But it has to be in a readable format. Why you keep the records? So the CRA at times, they like to perform audits on specific account balances for corporations or even for personal tax returns, going into specific credits or items on your business statement. So it's basically just to support whatever claim you're making. For example, there's meals and entertainment or travel, mini audits that the CRA likes to crack down on. And there's also some other specific account balances that they've been issuing mini audits on. So it's always good to keep your records. If you don't have the support, well, that could simply mean that expense or that claim cannot be made. Yeah. And how long you should keep them for? Generally, you should keep all of the required records and supporting documents for about 6 years from the end of the last tax year that those expenses relate to. Another rule or something to consider is to keep a fireproof backup as well as an electronic backup, as I kind of alluded to before. Perfect. So we're going to get into a little bit of compensation. So I'd like to start with going through what the difference between a salary and a dividend is. So as a business owner in an incorporated business, you have two options to basically pay yourself. So you can go the salary route, or you can go the dividend route, or for some tax planning purposes, you can do a combination of a salary and a dividend, and we can kind of get into that now. So on the salary side, you're able to contribute to the Canada Pension Plan. So then that's the employer portion and employee portion, both of which, if you are the business owner, you would have to pay into both yourself and the employee and employer portion. A salary will build RRSP room. So what that basically means is you can only build the RRSP contribution room from employment income. So on your salary, that'll generate RRSP room for you to make an RRSP contribution. The salary will also create a deduction in the company as salaries and wages to reduce your taxable income or your taxable income. And at year end or at calendar end for yourself, you'll need to generate a T4, which is a T4 slip to be picked up on your personal income tax return. Moving over to the dividend side, so dividends, they're taxed at a lower rate than salaries, and as I kind of alluded to before, so dividends are considered like kind of an investment income, and you cannot generate RSP room with investment income. So if you're paying in, if you want to pay into an RRSP or you have an RRSP, that's where a salary, you would need a salary to generate employment income, which will then generate RRSP contribution room. There's no CPP remittance required when issuing yourself a dividend, and you will need to generate a T5. So a T5 slip is very similar to a T4 slip and used for your personal tax purposes, except it's for investment income. Any questions on salary versus dividends for compensation?
I don't see anything on any of our chats.
Okay.
So yeah, I think everybody's just holding off to the end.
Yeah,
So-
yeah, that's totally fine. So now we're going to take a look at and talk about hiring employees and their compensation methods. So when you have employees, you can pay them in a number of different ways. You can pay them a salary, as a contractor, through stock options and benefits. So taxable benefits, it's important to understand which are taxable to your employees. As an example, if you reimburse them, your employee on a per kilometer basis for using their vehicle, that's not taxable to the employee. However, if you do a flat rate, if a flat rate is related to the kilometers driven, that is considered a taxable benefit. Okay, and offering a meal allowance for working overtime is not a taxable benefit as long as it meets a certain criteria. It's infrequent and works 2 or more hours of overtime, as an example. For stock options, this is a popular way for startup companies to compensate employees. They allow their staff members to purchase a specified number of shares of the company at a fixed price during a fixed time frame. They're a great incentive for your employees to work hard and grow within the company. There are tax implications as well as legal implications. So we would recommend consulting with a legal and tax professional before going into a stock option plan. And we kind of went we discussed a little bit of the salary in the previous slide, so I won't get too much into that. But there will be source deductions that will have to be remitted on a monthly basis to the government, as well as a T4 that will be required to be created and generated for your employees at calendar end. To get into a little bit of a contractor versus an employee, it's important to determine the two, because there's different rules as to if you are considered a contractor or if you are considered an employee. So the first would be control. Who picks the schedule and who creates your schedule, when you'll be working, and where the work gets done. So that's basically the first rule. So if, for example, your employee or contractor, sets their own schedule, determines when the work is done, and determines where the work is done, for the control aspect or the control test, they would be considered a contractor. However, you have to meet the other rules that we're going to go through as well. Ownership. So a good one would be if your employer, contractor, or the person working for you has their own tools. Do they have their own tools, or do you supply them with the tools that they need to get the job done? So if you supply them with it, then that would be more employee side. And if they provide their own tools, that would give reason to be more contractor. The third rule would be risk of profit. So does the worker have a chance to lose money on the job, did the worker spend money on this contract? And the employees, they would be paid a salary. So if they're paid a salary, there's no loss of profit. Whereas if they are a contractor and they lose out on the job, it's their loss. The fourth one being the dependence on the organization. So how many clients does the worker have? And is the worker financially dependent on the organization? So do they depend on you to supply them with their clients, or do they have their own that they can go and service? And finally, the fifth is, what is the intention of the parties? So how did the relationship start, and were employee benefits offered? If there are employee benefits, then it might give reason to be more of an employee than a contractor. So that kind of gives a little bit of a general overview on the contractor versus employee. Remember, there's the 5 rules or attributes that you have to go about. And finally, this takes us to our other considerations. So I think Blake and I are going to kind of go back and forth on some of these here. So the first one we had is your year-end date. A very popular year-end date would be December 31st. It's very common for a lot of businesses to pick that, as it lines up with personal tax year-end. However, it doesn't have to be December 31st. We have many clients with year-ends throughout the entire year. What I would recommend is considering when your busy and slow seasons are, given your industry, and pick a year-end date based on that. That would be one method. So I use the example of a landscaping company. Their busy season would be throughout the summer, probably until, let's say, October 31st. And then they would have the winter months before. If they do winter maintenance, they have a couple of months after October to get their record keeping in order before snow starts to hit the ground and they start working more. So October 31st for a landscaping company might make more sense versus July 31st in their busiest time of the year. Blake, did you want to talk about the rolling in the assets of a company?
Sure. So that basically deals with situations where maybe you've already started business as a sole proprietor and you've heard our presentation, you are interested in some of the other options such as incorporation. One general concept in Canadian tax is that most transfers should happen at fair market value. So if you have built up some value in your business, maybe you've built up a book of business, a client list, or have some inventory, and you want to transfer that to a corporation, it would generally happen at fair market value, which means there could be some tax implication to actually moving those assets. So there are some provisions in the Income Tax Act that deal with this and basically allow you to roll assets into your new company on a tax deferred basis. The main requirement in most cases is that you take back shares in exchange for your assets. So for example, if you have a client list that you wanted to move to a corporation, you would transfer the client list to your new company and take back shares of the company worth equal value. Another consideration if you do go the incorporation route is there's different types of shares. So you can have preferred shares, you can have common shares, and they can have many different characteristics. A few things to keep in mind: the common shareholder or the common shares are the ones that grow in value with the business. So if you are the one doing business, if it's your business, you would probably want to be a common shareholder to participate in the growth in the value, so that when eventually, if you go to sell the shares, they would be worth something more than you initially put into the business. Preferred shares, on the other hand, don't participate in the growth of the value of the business. So if they're purchased for $10 today, they'll always be worth that same amount. There are some other benefits and tax planning opportunities to preferred shares. They're commonly used with income splitting or other tax reorganizations and planning. But basically, preferred shareholders, they may have some right to participate in the corporation by way of a dividend. So they could receive a dividend based on the profits. Preferred shareholders might have voting rights, so although they may not, it really depends on what you're looking for in your business. And that sort of lends to the decision of who the shareholders should be. I will say there are some new tax on split income rules that really limit your ability to split income with other family members that are not involved in the business. So a spouse, children, it's very difficult to split income without incurring punitive tax treatment. But if you do have others that are participating in the business, you might want to also consider them being a shareholder. And between the shareholders, you could also have a shareholders agreement as part of the incorporation, also something a lawyer could help with. And similar to some of the considerations I mentioned as a partnership, a shareholders agreement might cover things like what happens if I want out of the business, or what happens if we want to bring somebody new into the business. How do we deal with those events? That normally wouldn't be dictated in the articles of incorporation. So you could have an agreement in place with your other shareholders. And then Eric, do you want to talk about a couple of the other items?
Yeah, for sure.
Okay.
So taking into consideration, meals expenses, for accounting purposes, meals are 100% deductible. From a tax standpoint, meals are only 50% deductible. So what that basically means is if you have $1,000 in meals on your financial statements, you'll see $1,000 deduction as an expense. On your corporate income tax return, only 50% of the $1,000 would be deductible. So only $500 would be a deduction towards your taxable income. And then finally, we had mileage versus auto expenses. So your auto expenses, you would be able to deduct your gas, insurance, repairs and maintenance for your vehicle at a percentage of the business use. So let's say you drove your vehicle 80% of the time for business purposes, 80% of all those expenses would be a deduction in the business. Versus mileage, the CRA has a acceptable mileage per kilometer rate. Blake, correct me if I'm wrong, is it 57 or 58 cents for the first 5,000?
I think so. It keeps changing. So
it does. It changes. Yeah, I remember when it was 54 cents. But I believe it's somewhere in that range on a per kilometer basis for the first 5,000 kilometers, where you can keep a kilometer log and charge mileage to the company or the corporation instead of your auto expenses. So there's two different kind of methods for deducting your vehicle automobile expenses. And I believe that concludes our other consideration section for today.
Yeah,
Awesome.
and I think that concludes all of our content, really. So we'll open up the floor to some questions. Angela, I don't know.
I actually do have questions that came in through Facebook. So if a company is in their first year of business and we register by middle of the year, do we need to file taxes by December 31st?
Yeah, I think the quick answer would be yes. Depends on the situation. I'm assuming you're referring to maybe HST there, although same as if you were to incorporate during the year, there would be a part year tax filing up until December or whatever year end you choose.
Perfect. And then I also got if we hire seasonal employees, for example, only for holiday seasons, are they considered contract employees? Do we need to pay them benefits and such?
I think the fact that you're referring to them as employees sounds like they're probably an employee that should be on a T4 and on payroll.
Yeah.
But again, like Eric was saying, it depends on the relationship. If they're really performing based on your terms, so you set the working hours, you provide the tools or the supplies they need to do the job, it sounds like they're an employee, but they're not necessarily entitled to benefits unless that's what you've agreed to with that employee.
Perfect. Those were the two questions I saw come up. So if no one else has questions in the room, I'll give everybody a second. Then what I'll do is say thank you to those watching on Facebook. Those of you who are here participating right in our Zoom meeting, please hold on for a second. Don't run away too quickly. But for those who are watching on Facebook or on other formats, thank you for attending. If you have any questions moving forward, do please send me an email at success@guelphbusiness.com and I can connect you directly with Blake or Eric. You can also reach them through them. You can see the slide right now, right through RLB as well. So thank you, Blake and Eric. That's always so informative. And we'll hope to see everybody again.